Super. Good morning, everyone. My name is Jeff Johnson. I am a managing director and one of the partners at Blackford Capital. We are a West Michigan-based lower middle market private equity firm that focuses almost exclusively on family founder-owned businesses, where we're the first institutional capital that comes in. And we target largely the old economy, industrial, distribution, and business services sectors. So great to be here.
Taurus?
Good morning, everybody. Taurus Richardson. I am based in Bethesda, Maryland. The firm is IMB Partners, which stands for Investors in Minority-Owned Businesses. Founded in 2010. We've done 8 controlled deals, one, and as an independent sponsor, one is a new fund we just raised in the last 3 months. We are mostly focused on utilities and government contracting.
Rob?
Yeah, good to see everybody. Robert Coven, Managing Director at Leonis Partners. We are a tech and tech-enabled services focused bank here in New York.
Hi, John Langston, founder, managing partner of Republic Capital Group. We are a boutique investment bank focused on financial services, primarily wealth and asset management, office right here in Rockefeller Plaza.
Hi, I'm Bob Goldsmith. I'm the president of Northern Edge Advisors. We're a sell-side M&A advisory firm with offices in New York and Fort Worth, LA, Toronto, about 35 professionals. All the bankers are former Wall Street trained M&A bankers, and I'm based in New York.
And I'm Corey Masella. I'm a managing director at UHY. We are a national accounting firm with about 30 offices, about 1,800 professionals, and globally we're in 100 countries. My focus is really on the diligence side, and we do buy side, sell side. We do about 40 to 50 deals a year. We also, from the accounting side, are also managing a lot of family offices, especially international, that come abroad. We handle everything for them. We do PE groups, and we handle a lot of strategics, and a lot of the strategics we handle are also international coming into the U.S. So those are a couple areas we deal with. So the first question. During 2023, what has been the impact for you of the higher interest rates, inflation, stock market volatility, and the political divide? Discuss areas that you may want to mention. I know that's loaded, but it's just let everybody let it out and see what they're dealing with. So who wants to take it first? I'll open it up. Taurus, why don't you? Yeah.
Sure. So, last year or this current year is a year where we're basically coming from a independent sponsor model into a quote-unquote, fund model. And so for capital raising, it's sort of one of the slower, hardest markets we've seen. We went out to buy 2 companies this year. We closed one in July, and then the other one got hung. We were trying to raise, call it $18 million. We wanted to do 9 of capital ourselves and then 9 from sort of co-invest market. And that market, which was wide open 24 months ago, we probably talked to 100, 115 people and just couldn't raise the capital. And so most of them were saying we're only doing deals with people that we currently have an LP relationship with. They all felt like they had, if they typically had 5 things they were working on 20. And so they had choice in terms of the market. And it just made us have to sort of conserve our capital and make sure that we didn't put too much equity in one deal, so we busted. And then on the capital raising side, we thought we had $100 million sort of committed. We saw sort of probably $50 million go from a 23, sort of capital commitment phase to pushing out to 24. And it just feels like most of the LP market is closed for business for 23. They don't have the money. They haven't gotten enough re-ups or, sales from their existing GPs. And so it's just a very tight market for capital raising.
Yeah, I just want to add, you are confirming an article I was in the Journal on I think it was Saturday. And within the article, they were talking about how tough it is for capital raising if you're doing buyouts. But they said the LPs will be they'll fund alternative forms of lenders in alternative lending. They feel more comfortable with that in this current environment. So it really has put a damper on everybody that's, in this business. You're hitting the market just like the wrong time.
Yeah.
So,
Exactly right. And to that point, like private capital returns are probably tipping up to 13 to 18%, which is not too far away from what they expect or model from a buyout perspective. So it's like the most incredible market ever for, unitranche and mezz capital.
Rob?
Yeah, I mean, we're definitely not in the, kind of the LP capital raising world. Definitely what we do plays through to it. The lack of liquidity, you'll hear a lot of the LPs refer to it as DPI. In other words, they're not getting cash handed back to them. They're looking at marks, but sitting empty-handed on the cash. It makes it very hard to commit. I think, what we're seeing is a corollary to that, which is, the private equity community has been very active in the middle and lower middle market for software and technology, where we spend a lot of our time. This year, much more in a bolt-on fashion, right? So the safe defensive play throughout 23 for us at least has been, keying into those kind of private equity realms where there is already a pre-existing platform. That platform often has financing behind it. Maybe it's an accordion facility. Maybe it's the private equity firm already being comfortable with 12 to 24 months of underwriting and feeling like in their hold period they've got that stability to really make a commit. So we're seeing, the ramifications of that lack of re-up or that slow re-up is really, I think, also, kind of twofold. One, it's the GPs sitting there very slowly, methodically looking at platforms at a level that I think is, probably very reminiscent of early 2020, or maybe even, the early 2009 to 11 time period. And then, as a result, where they're trying to get money out the door, we're seeing it in the bolt-on world. So that for us has been, this year, much more of our bread and butter than probably it has been in the last 5. So we're seeing parts of that for sure. The strategic side, I think people's cost of capital is intrinsically up when you take the cost of credit up. That plays into asset pricing. It plays into conviction around, NPVs and other calculations when you go in corporate boards. So, across the deal land, the cost of capital to fight the inflation headache that we've all had has definitely impacted valuations and velocity. I think every vertical, when we talk to bankers out there, they're feeling very similarly. Definitely in the software and technology landscape where growth is a very heavy component of valuation, where those future dollars are a lot less worth what they used to be when you're discounting them at a much higher rate, and obviously that plays through multiples. So, it's had an impact. I think, the real question I would be curious from the private equity guys is, on a deployment cycle, if it feels a little slower, if you do have a committed fund, at which point do you actually have to draw down those commitments so that you can go into the next fundraising cycle in the next 12 to 24 months and really showcase you can deploy capital. So I think that fear is going to probably, as we talk about 24, I think there'll be some bottled up demand of trying to catch up on that cycle, much like we saw in kind of the late part of 2020 and early 21. So,
John?
Yeah, we're in a little bit different space, and fortunate that things have remained very active, very strong. So I can talk a little bit about maybe the psychology of things. I'll let my colleagues here talk about the technical aspects that they're covering, which again, in the asset and wealth management space, things remain very robust. I think maybe we're off 8%. I would even argue about that number, but which is certainly held up very well in the climate. What I think is interesting about this time or in these types of cycles is psychology of both bankers and business owners. And I find it, even though we're in an area that is very robust and very strong, because there's so much commentary about the challenges, some transactors, both in the banking seat and a business owner, have a dim view, and they start out the process already behind the 8 ball. So I always, on these types of panels and things, try to be pragmatic. I would tell you that your own psychology, your own goals, the strategy and team you've employed still have a tremendous impact on your ability to get a transaction done in your specific situation. And so I've been sort of watching that and fascinated by, perhaps executives or bankers who don't realize we're in a bit of an oasis, and I say that thankfully and gratefully. But I think that's a kind of an interesting thing I've been observing in our space.
Yeah, so I think our experience has been that it's been a challenging market, but not a terrible market. And so we're seeing, a little bit of price compression. I don't think as much as they may see in the technology sector, but good high-quality companies that are add-ons in particular are still holding on to good pricing. And so it's been a good market for that. it's taking more time to uncomplicate complicated stories with our clients and to really work through any of the issues, because as I think people know, small issues now in deal processes have really negative results. More earnouts, a little more contingent payments to manage risk. But on the bolt-on and add-on part of the market, we're seeing lots of deals getting done, and even the platform deals, if they're really not too complicated, or the story is not too complicated, if there's a real rationale for buyers to make the investment, those deals are getting done as well. Most of our clients are less focused on timing a perfect market than avoiding a really bad market. I think if they really want to know if there are going to be buyers out there and if it's really a terrible time to be in the market for their particular business. But otherwise they're driven by other interests that they have, their personal interests, family. We're working with a company in Texas that's got 5 shareholders, but as they put it, there's 102 families. They want to find the right home for the business. There's managers who are owners, right? It's like the real world of business ownership. There are managers that are going to continue on with a buyer. It is really important who that buyer is. And, the notion that everything is the absolute top dollar that you might find in a year or 2 from now, and we should work with them to make minor improvements and change this or shift that over the next 2 years when the market might be better, is not really their concern. There's some primary shareholders that really want to have liquidity now, so there's pressure to do that, and they just need to figure out, where they're going to go with it. And I think that's representative of lots of the owners that we're working with in the business owner community.
So, do you want to say something? Go ahead.
Oh,
I'm gonna try to
I would
skip
just
you,
say
buddy.
real quickly.
Thank you.
So a couple themes that at least we're seeing from the private equity side. One is that unquestionably, I think that the underwriting bar has gone up quite a bit on both the debt side and the equity side. The capital just isn't there, and I would echo almost everything that Torres said. And it's just a challenge. There's a lot of limited partners that their asset allocation models are still out of whack, and until they get some of these returns that they're expecting, they're just not looking to deploy capital. The other theme that we're seeing is that it's actually a really, really good time to be an alternative debt lender right now. The traditional banking market, which was kind of the first, place that we would always go to secure our senior debt financing, is in many instances just non-existent. There are some banks that have just told us they're just out of this business for the time being. There's an enormous amount of interest on the LP side to find these alternative lenders. I think that from the alternative lending standpoint, a huge portion of their competition has been removed. And they're seeing credits right now that they're getting paid a whole lot more for, that require more equity in the transaction to get done. And they're quite frankly just much better credits. So if you're an alternative lender, I think that this is about as good of a time as you've seen in the last 10 to 15 years.
Yeah, and under the current environment, we're seeing a lot of deals are slowing down. And they're slowing down because of exactly to that point. It's the, how much the original, because it kept moving all year. And, as it kept moving all year and there's deals in process, all of a sudden, you take a sponsor. The sponsor's got to come up with a lot more money up front because the leverage isn't there, and then they got to go out and find a lot of lenders with those challenges. You take PEs, they're exactly in that. They're being looked at right now, and the returns are kind of not there, and they're also some of their portfolios. Some aren't, depending on what sectors they're in, aren't in good shape. So it's been a little bit of a compression. So that leads me to the next question, which is let's talk about structuring, because in this environment, you kind of alluded to it, Bob. The structuring has really been we'll call it. The sellers are asked to do a lot more than they used to 3 years ago, and more engaged. So I'm going to skip. So who wants to take this question first? Because I'm trying to be fair. Jeff, you go first. All right. All right.
Well, one aspect that we're seeing is that from a microeconomic standpoint, I mean, it's kind of a double-edged sword. Not only is the market a whole lot more difficult. But quite frankly, the companies that we're pursuing, some of their underlying results have been volatile, to say the least. So the challenge is you could, have a deal that's largely sewn up, and then, either a QV analysis comes back that has flaws in it, or quite frankly, they just haven't hit their numbers. And as a result, your various partners then want to re-underwrite the deal. And so that's in part kind of elongating the structure and just the time frame as well. The other thing is we're seeing across the board, all of our deals are requiring more structure. That could include seller notes. It could include earnouts, whether we're on the buy side or the sell side. Without question, we're having to put more equity into the transaction because the lending partners are requiring it. So at least from my perspective, almost every transaction we're looking at has a tremendous more amount of structure on all facets. And quite frankly, it's what the limited partners and our investors are looking for. So unless we bring them a transaction that has those type of merits to protect them against the downside, they're just not as interested.
Yeah, I think for me, I've been doing this 30 years, and this is the first market where I've seen the middle to large market more stuck than the lower middle market. And, the syndicated loan market, the debt market has been shut down pretty much for 18 to 24 months, depending on size. Everything is rotated down. And so you're seeing, billion-dollar firms doing $5 to $15 million EBITDA deals, which they would not have done. They're doing that because at the end of the day, the cost of capital is up 5%. The ability to put more equity in is how you're basically getting deals done. And so they'll take the shot of doing lower value deals and doing a build-up, as opposed to trying to do a larger deal where getting $100 million loans and above has been shut down. And so for us, it's meant more competition. It's meant we are rotating down. So, in March last year, we closed a $100 million deal. Right now, we're trying to play into 15 to 30 because we need to know that we can control the capital structure. The problem with sort of the regional bank market being shut down really since, when SVB and First Republic sort of shook back in April, that credit lending process within banks basically went on hold. And yes, we love the fact that alternative capital is here, or private capital is here. It's just far more sophisticated. It's 5 points higher. And now you're dealing with somebody that is way more interested in sort of pressing on you if you bust covenants or if you get tight in a way that it just makes you want to slow down.
Rob, you just mentioned SVB. Why don't you include that in your tech discussion?
Yeah, I mean, well, I think there was an interesting, couple of weeks right at the beginning of March. In a lot of different ways, we got a lot of interesting phone calls from, a number of private equity firms or VC firms that had, either at First Republic or SVB, they had subscription lines, they had other lines that were, more importantly, their company's lines. So there was this fear, obviously right out of the gate that, overnight that lending, kind of facility and that crew would dry up. And not only that, the cash that was at those banks would be locked down. So that obviously shook a lot of things, I think, back in March and early April. I think it was a little bit of a wake-up call. I think since that time, we've seen people be a lot more prescriptive about structure, partially because of that. But I think partially it's a bridge on valuation. Where we live in the tech side specifically, there has been a pretty pronounced public market adjustment, especially if you kind of strip out the big 5 or 7 tech guys out there. The market really actually looks flat to down this year for a lot of the technology sector. And so people still recall that multiple they saw in 21 that their buddy got, and heard about in the locker room. And they're looking at their business and saying, well, why can't I get that? And the answer is we've gotten into a very bifurcated market. It's a flight to quality that we've seen in other asset classes. We're seeing it within software technology all day long. The companies that have really good KPIs right now, we're actually seeing them price better than they did in 21. I mean, we're trading things at double-digit revenue multiples. Yep. If they're growing, if they're profitable, profitably far more important these days. If they've got the right retention profiles. These are things that within software matter tremendously. And it's to your point, which is the big sponsors are coming down market over equitizing deals to either say, hey, we'll build a platform out of this, or we'll delever it later when rates kind of readjust back because there's a viewpoint that rates either come back down or flatten. So we have seen that pressure, that downward pressure, in those processes, and they're really focusing on good assets, because if you're coming down, the last thing you want to do is also have hair on it. Those are moving quite well. And anything that doesn't live in that top quartile or decile of KPIs within the ecosystem, that's a different ballgame. And with owners, you really have to understand, why are they wanting to go to market now? Are they sensitive to valuation? Do they have a full understanding of what the real valuation is? And I think there's been a lot more kind of clarity kind of offered to owners in the last 6 to 12 months. And I think we're just beginning to see the beginning of reality setting in, where you know what bucket you're in of those two, and you know where the market's pricing, and you either decide to go or you don't. And I think that the early part of March of last year, into the early part of this year, there was still a little bit of information dissemination going on, markets readjusting. I think we've had 6 to 9 months where it's pretty clear what's going on. And, as long as people are intellectually honest as advisors, I think with the clients out there, they know whether they want to go or not, right? And so I think as we get to the back part of this year, a lot of the breakage, the retrades, the stuff that's been a function of performance, it's been a function of value stretching. I think that starts as you get into 24 ameliorated, because I think the reality is set in strong enough that people are accepting the reset. Structure's been a big key, though, for the deals that do have that hair. Financing, right? So seller notes, great way to get leverage in there. You kick it out past the exit point for the sponsor. The lender looks at it, subordinates it, says that fine, that works, right? That's a nice bridge of capital. The earn-out structures in vogue, we in 21 would have said a deal with an earn-out on a decent asset, it's pretty non-existent.
Yeah.
These days, I would invert it and say a deal without an earn-out is a pretty perfect asset. And so you've got to make sure that, again, people, as they think about value stretching, understand that it may come with structure. Otherwise you're setting yourself up for, probably premature failure, at least within the ecosystem that we cover. So we've seen it play through in a number of ways.
Don?
Yeah, I'd like to thank Robert for pointing out locker room multiples. Roger, we should do an entire panel on that next year. Just the gap between perception, discussion, and reality. Now, it's the same for us somewhat, in that high-quality firms are not experiencing really any change in value. In fact, in our world, there are a number of prolific acquirers, and 2 of the top 5 have called me and said, John, I want you to know that we plan to be more aggressive in 24 against this backdrop that we're talking about. So this sort of back to a little bit of my theme about people's perception of about what's happening around them, and how I'm getting those calls from 2 of the top 5 acquirers saying we'll be more aggressive on price and value, everything, because we want to do more transactions. So definitely an oasis. But within that same within our same sector, we've got major voices saying, well, the slowdown's coming. So again, it's interesting how that perception sort of leads to defending that position. Again, I feel a bit out of place here, maybe other than Robert here, who said they're still seeing some opportunity. Thank you. So look, I would say structuring-wise, definitely seeing more earn-out. One aspect of it, though, I think for some sellers is they are comfortable taking a longer earn-out, maybe tied to growth, because they feel like they can recapture some of the previous growth. So we've had some instances where our clients actually been saying, hey, I wouldn't mind a little longer earn-out opportunity. But I don't think we're seeing much different. Companies that have challenges or flaws, definitely there's a lot more choice. The other thing we're hearing in our space from the largest acquirers, largest investors, that they have their largest pipelines ever. Back to this idea of there's 20 opportunities. And so I think for the smaller seller, they need to be very aware of what Robert's talking about. Where do you fit? Are you that high quality, high growth? Are you lower quality? And frankly, I think that's a big part of our role, helping them truly understand where they are. I'm an entrepreneur. I built a company from scratch. My partners helped me see very few flaws, very few, but my partners helped me see that. And I think with our clients right now, helping them really frame where they fit, maybe without breaking their view of their baby, so to speak, in terms of, what they've built. But somewhat similar to what has already been shared here in terms of high growth or high quality companies really being strong, and then those that are weaker having challenges. Robert?
Well, let me just chime in for 1 second. One other thing in the structuring that wasn't mentioned is rollover. A lot of rollover equity.
Yep.
A lot more higher percentages of rollover equity being requested wherever they can push it, especially if you got a strong management team with different agers and bifurcation, and you can kind of bring them forward, going forward. There's a real push for, it's not just at 20. People are pushing higher now, which you didn't see before. And then the seller notes, some of that, as you indicated, So I just also wanted to mention that you're mentioning that people are willing to take the earnouts, and they're willing to move with the earnouts. And what's crazy is on a lot of deals we've seen, there was such a backlog of what was happening because of COVID that 22 was killer, okay? And it was a lot of backlog. So we were true enough for with the problems with COVID, and then you went to 23, and all of a sudden, when you really looked at it, you just weren't looking at 2 year. You were really trying to look historically because you were paying a much higher multiple on that EBITDA because some of it was backlog. Then they also, you get the circumstances, as you just said, that you've got sellers that realize that they still have the pipeline, and they had to, with the labor issues and everything that's going on, there's high potential for earnouts in the future. So those are the good circumstances. I just wanted to give a little color of what we saw that you mentioned.
That's good.
I was gonna say, I mean, we may have the slingshot effect if the economy stays strong and interest rates and inflation are sort of managed as we think they will be. And I think it is analogous to what happened in 2021, why we had that, those big bull markets. I had read that for truly middle market firms, something like the number of firms that are in prep is up 50%, which I think is exactly what you're referring to. So if things align, then things will be very good next year. I think what there's a real risk is that we probably all have lots of business owners who are thinking, next year is the year, next year, I've perfected it, I'm ready, right, locked and loaded. And if there's some hiccups, if things don't turn out that way, I think there may be, not to be a doomsayer, and I don't know what will happen, but I think if it occurs, if we hit some real roadblocks, and we've got some, big issues coming up in 2024, then there may be lots of people that are pulling back from the market. And, I do see with a lot of our business owners, these aren't forced sales, right? They're voluntary, sales, right? It's not an investor that's, sitting on a mountaintop somewhere with the management team running the business. They're in the business, and so, and they're, and they're earning the money. So that will be important next year. The other thing is that, in terms of structuring, we think it's just important to go out to a larger pool of buyers now because there is less certainty. And I think we were in a period, 2 years ago where there were things were slightly driven by a fear of missing out. I mean, these were really good days, and now it's, we're sort of more looking for that sort of golden goose, that will give but doesn't have too much risk and is, can really be managed. So we're having to talk to our owners about really understanding why particular buyers are interested in your business, trying to figure out how it really fits together. This is not sort of optional. It's sort of optional selling, but it's also optional buying. I don't think buyers are going for things like, we'd sort of like to add this on. It'd be interesting to have.
That's going to go to the next question. So let's just go to that because that's going to feed right into it. So let's talk about the sectors, hot and cold sectors, because everything you're saying, it all depends upon who's hot, who's cold, and it's definitely it's very specific these days. So, John, you want to kick that off?
Yeah, sure. Look, I mean, our world is financial services, as I've mentioned, has been very robust. That's really our narrow focus, and so I'll let the other guys on the panel comment on other areas. I will say one thing that I think is interesting, maybe happening in other sectors. I'd love to hear from others. We have a lot of activity in what I would call parallel spaces. For example, earlier this year, we helped a firm called Creative Planning, which is probably one of the top 4 largest independent wealth management firms in the U.S., by a very large CPA firm. What's happening is within our world, there's a focus on expansion of services. And so accounting firms, trust companies, maybe even a little bit legal. And I think interestingly for this audience, we have among some of these national large players an appetite for investment banking capability. They want to acquire boutique and banks to sort of insource them into the overall operation. Some of these firms have thousands and thousands of business owners as clients who are thinking about liquidity, succession. We'll try to coach them all, not for next year, but up to Robert's point, which is a good one. But so that's something we see in terms of our sector, which again has remained very strong. And given our focus there, I'll let others comment on other areas. Corey?
Taras?
So I'm in 2 spaces, one in the government contracting space I'd say it's green lights all across, short, medium, and long term. There's been a lot of sort of infrastructure spending bills that happened in the last 3 years, and so most agencies are spending money. DOD and the sort of three-letter agencies are all very active because of the sort of geopolitical risk we have right now. So green lights across. I'm also in the utility space. It has historically been a great space. They have a fair amount of spend that they had gotten from infrastructure bills as well. And at the end of the day, the interest rates caught up with them around July. And so you see substantial slowdown in capital spend projects across all the utility space. They basically manage to a budget, and if more money is going to interest expense, they have less money to spend on projects. And so the capital sector or the capital spend is down, and then even on the maintenance spend, which is supposed to be more methodical, they push to the right. And so you've seen for the first time in like 5 years, across the sector, everyone's sort of spend is down for the last 6 months. But my sense is that they got to rebuild the grid, they got to rebuild the gas utility, infrastructure underneath as well. And so it's medium term, long term green. Short term, it's quite frankly yellow to red in some markets.
Jeff?
Yeah, I mean, amongst our portfolio, we're seeing an enormous difference depending on the end market sector. Areas that, continue to be very, very strong for us are, one, healthcare in general and specifically medical products. I think that the recurring revenue base and kind of, flight to quality in that perspective has been real strong for us, and it has not been difficult at all to get, add-on acquisitions financed there. We also closed a deal several months ago in the business process automation space, which is another area that seems to be very much in favor right now. And we've got 18 companies that we're pursuing for a possible, add-on acquisition. We've got 3 letters of intent signed on deals that we're trying to close right now, and we're getting very little pushback from our lenders. On the flip side, we've got some exposure in the traditional consumer ended, space, which has been a real challenge. The underlying companies have had a lot of volatility in terms of their earnings, but I think that, anything that's consumer facing continues to have a great deal of scrutiny, and some transactions that we've been pursuing there, quite frankly, have just been stalled because we've been unable to finance them.
Rob?
Yeah, I think it's been very, we cover from a technological standpoint, but we actually look at it, we do a lot of vertical kind of specificity around the underlying markets and who we serve in there. So it depends on the verticals that will line up almost to a T with the macro trends here. I mean, the government technology side's been highly active, very well priced on the software side. I would tell you along with that is cyber, right? Those assets are holding up, if not accelerating, just given some of the trends. Public sector, we've seen pull back a little bit as people worry a little bit about the macro kind of out there and tied to real estate. Well, it's stayed up. There's a question of how long will it stay up. In a lot of the K-12 worlds. In insurance, that world has stayed robust, so the InsurTech, the few deals that have gotten done there are very robust this year. So really, I would tell you, it's the tailwinds of the economy. The HCIT side's been pretty robust. What I think, you see is a lot of the utilities, we've seen some of that kind of pull back. So I think we're just seeing a broader look at this because our end markets for the software and the technology, really a lot of those are vertically specific, and they're mapped very tightly to what's going on in kind of a broader context. We have seen holistically, for those areas that aren't rapidly accelerating, like a cyber or something like that, it's kind of the same thing I hear in banking from a lot of bankers, whether it's up market, lower market, mid market, which is, hey, we've got a huge pipeline. And it's like, well, the next follow-up question I have for the software and the IT service businesses are, that's great. How's your conversion rate? And how fast are you closing? And the answer is, it's a little slower. Oh, we're going to go next year. Like, we've got a huge pipeline, though. Maybe it's soft landing in 24. It's the same. It's an echo of what we as bankers, I think, are saying a little bit in some of our own pipelines. But I think there is a definite trend of pullback in IT spend or delay, not necessarily cancellation. On the IT services in the project-based world, we're seeing those with a little bit more cancellation. The mission critical stuff is still getting done, but people are definitely prioritizing. And I think that's what we're seeing kind of across the IT and software spend ecosystem.
Bob?
Yeah, I think consumer has been weaker. And then in the last deals that we've done, we've been very strong in professional services. We sold a company to Witham that does loan review. We sold, Yesterday, we sold a company, uninterrupted power supply, that went to a private company. A company called Power of Clean Energy, which does energy services. So, those businesses are strong. Manufacturing, and I think manufacturing technology,
Yes.
businesses that are really staying up with the times in terms of robotics and 3D printing and sensors in factories. I really like the pharmaceutical space, engineering, pharmaceutical, reshoring, people that make stuff and engineer stuff. And the reason why is that these are trends that are going to continue over a period of time, and particularly for strategic purchasers with a really longer time horizon. It's not about the specific value that you sell it at today, but rather what are they going to do with the business over a period of time. So we found lots of strength in all those spaces, but particularly for the companies that are sort of 2 million to 12 million EBITDA or some range like that. It's just whether they're good companies. I mean, I think for the bankers here, a lot of what we're doing is just doing quality preparation, doing quality work, because these are businesses that ought to be sold. They're going to be good value over time, and with the exception of some industries that are just really too scary right now. We try to, we'll tell that to the client that we need to, we should really be waiting. But for the others, it's about, finding the right people, running a process where you get the, interested parties and get them into processes, and then we're going to get a transaction done. And there'll be hurdles. We'll have to figure out the earnouts and all those things. But, we'll find a way to they'll find a way to get financing, and we'll find a way to overcome the other issues.
So we, there's been some oddball stuff that's going on that kind of baffled me. And we were on the phone. You weren't there, but HIVAC has been hot because of the recurring, but and then also landscaping with the recurring revenue. Two sectors you would never have thought that people wanted to take and start to consolidate. You understood medical, part of medical, and that continues, however it keeps continuing, but those two areas have become hot, and I think it's because people had to deploy capital, and they started to look at some areas that kind of made sense. So those are some of the the oddballs in the lower middle market that you see going on. Everybody's trying to get that recurring revenue areas that looks like it could be consolidated, but with that you're dealing with certain personalities. So those sectors are tough entrepreneurs to deal with. But it appears to be working. My next question is going to be about the fourth quarter. All right, we're in the fourth quarter. Let's talk about the close rates. How you see the close rates as compared to like last year? It's definitely something to be discussed. It's definitely some challenges out there. So, Rob, you look like you're about to bite on that one.
Yeah, no, I mean, I don't think we've seen. I really think a lot of the world really since probably May or June of last year, I don't think the behaviors changed that much. I think people have just gotten more akin to it and more used to it, more data points on it. In the fourth quarter, when we look at our small, kind of window of the world, I don't think we feel like a massive deceleration or acceleration. We feel like it's probably very in line with what we were doing in Q3. And as we look, like there's decent pipeline going into next year, but again, it's kind of this question of, all right, do they go, is the timing right? Is the economy right? Do we have 2 wars or 4 or 0? There's a lot out there that I think nobody knows. But in terms of just current, we haven't seen a catalyst that's caused anybody to really jump in or pull out. I think people are letting this rate infrastructure as it flatlines out and kind of tops out, and people are trying to figure out, does it stay there, does it come down? It's their cost of capital, both strategically and in the private equity landscape. So we kind of look at it and say, well, until we've got line of sight on where that is and that forward curve on interest is really a little bit more known, as long as there's not a lot of instability around it, we're probably, hopefully we're kind of taking along the bottom of an M&A market, but at the same time, it doesn't feel like the gates are quote open yet. It feels like everybody keeps delaying that 6 months out.
Yeah.
The pipeline's only 6 months to begin with.
Tars?
Yeah, I'd follow on to that comment, which is deal activity that's going to close now really started 6 to 8 months ago. And 6 to 8 months ago, people didn't know what was happening, and people started to retrench. Sellers had not capitulated on price, terms, and structure. And so this fourth quarter can't be a robust close market because 6 to 8 months ago, sellers started to get pulled back and decided to, hold until they figured out what was happening. And then the buyer market is anxious about credit and/or capital raising. And some investors are starting to say, please don't call capital because they're out of dough. And so this can't be a robust fourth quarter from where I stand.
Jeff?
We actually do plan to close a transaction in Q4 before the end of the year, which is good news, but this was also a transaction that we've been working on for a little while now. I'd say that year over year, we're definitely down from our activity last year, but deals are still getting closed, but they're taking on a slightly different look. We're having to put more equity into the transactions than historically, and then they are heavily structured. And you raised a good point. I mean, we pushed very, very hard on seller roll, and for all the transactions that we currently have under letter of intent, there's a pretty significant seller roll component across the board.
Yeah, we're seeing, there's still a push. It's slightly down from what we're seeing on the closes that we were involved in. But we're also seeing that everybody's a little more lax and willing to push into next year, and that includes the sellers. Whereas before, there was a lot of pressure to try and get it done before the end of the year. John?
I think it's the same. In our space, we had a catalyst around some tax legislation that kind of pushed people. But like Robert said, it doesn't feel like there's anything driving it right now. And we have a few situations, sort of ironically, where they need to close sort of January 1. And so, yeah, but no catalyst causing it to accelerate. But I mean, for us, we're up in activity, but that's just more of, again, a function of where we are, not just industry-wise, but as a firm. But I wish there was a catalyst. Yeah. But my brother and I, years and years ago, were in business together, and we used to call him the Grinch because no one wanted to close anything between Thanksgiving and December. And he's like, nobody wants to work. So there is that element, though. So, yeah, I mean, people are distracted by other things.
Oh, yeah.
Yeah, I don't know. I mean, the deal that we closed yesterday, we signed up in July of last year. I don't know if that's short or long, right? It sort of feels long, but on the other hand, we're all working in the middle market where we spend a lot of time preparing.
You worked hard for that deal.
You worked hard for that deal, and as an accounting issue, it's not that you just you sign up and then all the financial documents start to arrive and everything else you're going to need for due diligence. So there's lots of work. We also closed a deal, a couple of months ago that we've been working on for 5 years. I'm incredibly proud of that deal. That says something about our institution, I think, more than about anything to do with the market. They, they had some hiccups and we worked through it. And I think there are going to be more of those deals like we had during COVID. There are going to be more of those deals where you just stick with it. Obviously, processes are extending further now. And, like in other markets, we're always going to have the client where we don't hit the value that they're looking for. And I think us bankers like to call it, greedy behavior around large sums of numbers. Like, I actually did hit the value. I actually hit better than the value, and now the value kept getting higher. But that's okay. And then there are businesses that have, the flaws that, or something happens to erode earnings, for instance, and that's a problem. Obviously, flaws we're trying to anticipate, but there are a lot of things that come up in processes. And to go back to an earlier point, it really is about, really having things buttoned up. So, it feels like the market is sort of lethargic. I think some of us bankers that can shift over into more of the lower middle market or, what feels like add-ons, it's the one time where it's really helpful. If I look at some of the bigger financial institutions, just as an aside, we don't think the bankers are better. My partner was a senior M&A banker at Goldman Sachs for 17 years as the COO of their business in Europe. Our bankers are outstanding. But I think in these environments, if you're a firm where you're running overheads, your fixed costs are lower and more manageable, you have a real advantage.
Totally.
When you don't have to say, our minimum fee, it would feel good to say, our minimum fee is $1.5 million. Don't even come talk to us unless you're, because you know what our minimum fee is. I think it is really helpful when you have flexibility and you can hit lots of singles and doubles and help business owners, help, in quotes, real people, and also, get through markets and make a living at it.
So, and a quick story, and then I want to ask about 2024, okay? You've got certain situations, and a prime time example, real time right now. Company was able to, because of coming out of COVID, and they're very much subject to commodity prices, okay? Coming out of COVID, they were able last year to push the prices up on the customers. Commodity prices have sunk in the last years. So now the question is, you know, what's identified is we damn well know those customers are going to come back and compress those prices they're paying right now on those contracts. So you're right in prime time negotiation, and you want to close before the end of the year. How are you going to settle this out? And obviously, it's got to be through an earn-out of some sort. But these are the real situations that are going on now. Everything is not steady Eddie, for sure.
If I understand the issue correctly, I mean, I think there's a lot of tolerance on pricing issues during COVID when there was the sourcing lockup. I don't think customers are allowing or being so flexible, but pushing through margins now.
A little bit, but yeah, that's part of it. And then we have a very sophisticated group that's running this company that was smart enough, and they put in the LOI something about a fairness opinion, and now we knew why. But that's another story. 2024, crystal ball time. Tell us what do you see going into 24?
You know, it's going to be interesting. I think that the last 2 years, there's been this kind of dichotomy where, the public markets have obviously declined in price, and private markets take a long time to catch up. I think it was Steve Schwartzman who, once said that, the markets typically take 18 months or so to kind of, normalize and have sellers kind of acknowledge the market and the state of conditions that we're currently in. So we're really kind of coming right up against that 18-month mark. So I'm actually cautiously optimistic that volume is going to, steady and start to increase. But I do think there's going to be a valuation reset. And, I think that a lot of the trends that we're seeing on the finance side are going to hold, into 2024, where deals are going to have more equity. There's going to be more structure. It's going to be a different universe of lending partners. I think that the unitranche players are going to continue to do really well. And then, from a sector standpoint, I think that, again, this theme on recurring revenue, I think is going to be paramount. Big project-oriented businesses that are tied to new home builds, in the building product sector, or, businesses that are tied to the interest rate environment, I think are going to have a much more difficult go with it from a valuation perspective.
Yeah, it's a tricky outlook, right? There's too much overhang of M&A activity that's been off 30 to 70%, depending on what industry, for the last 24 months. And so people are going to price, right? And the capitulation will come in 24, maybe 25. But the problem is that there's too many market forces going different ways. So we don't know interest rates. We hear it's going to be a soft landing. Okay. Geopolitical risk is up at levels we haven't seen. We may be playing war in 3 different markets. People haven't priced that in yet, don't know what it means. The political risk of the elections in 24, people don't know what it means. It can have tremendous tax implications one way or the other. Sell in 24, don't sell in 24 based on outcomes. And so at the end of the day, I think there's going to be more activity in M&A. There's going to be a little more certainty in sort of the visibility of cash flow streams of companies, because we've gotten off the bubble of the 2021, now 23 decline in sort of earnings of companies. But in terms of is this going to be a robust bust year? It has to be sort of a flattish year, because you're just going to have so many more inputs that you're more clear on, to where 25 and out, you're going to be a much more informed buyer. We usually make a lot of money in down markets, but in this market, it's got too many variables. And so I think the smartest buyers are going to play safe, and the sellers aren't going to be ready to capitulate.
Yeah, I think, where we look at it, it's probably a little bit of a slice of the market, right? I think there's a difference in upmarket M&A behavior that you see on the front page of the Wall Street Journal every morning, the multi-billion-dollar deals that drive dollar volume of M&A. I think as you look in the mid-market, that at least that's probably where we have our best shot at intelligence. I do think that, as much as I believe in the altruism of private equity, there is a point at which, when you look at a fundraising cycle that was 2020 to 21, and you start mapping out 18 to 20 months or 12 months if you're aggressive to raise a fund, and back into that and aren't showing DPI, you're going to have an issue. So I think there's going to be a place where these private equity guys have sat back a little bit this year and said, I'm not sure. We all talk about the individual seller. The private equity guys aren't exactly showed up to the market with assets to dump into the market. Tells you something about their view on pricing, I think, or at least where their mark is relative to where it may be. But the net of it is, I think next year, between the LP pressure of getting capital back, the fundraising cycle pressure of looking ahead and saying, hey, if I ever want to grow AUM, which there's probably some incentive in the industry for that, I think at some point they're going to have to sell assets in these kind of longevity kind of vehicles that are out there that are basically continuation vehicles. I think they're going to get to a place where, when we talk to LPs, idiosyncratically, what we're hearing is they're having to look at those and say, hey, 9 out of 10 of them are kind of garbage because somebody really has got something overhanging. They just got to get some liquidity back. We don't want those. The 1 in 10 are awesome. We want to get in those. I think that's going to go by the wayside. People are going to actually have to sell the assets. I think as they sell the assets, hand back capital, you'll see commitments. You'll see people getting ahead. So I do think that you'll see that part of the market on the equity side unlock. I'm curious as to how they think about some of their cost of capital there when rates are up 5% from what it used to be. So I think as you see those private equity guys come in, I think you'll see both them being willing to sell and to acquire. I think that will make a big difference next year. I think the election uncertainty is probably hardest on the entrepreneurs that are looking and saying, well, if we have a Republican win, are my rates going down or locked in? If we have a Democrat win with stuff rolling off in 25 on the estate side, where are things going? So I think the back end of the year is actually a place for uncertainty around the entrepreneur, probably more than anybody. But I think the private equity guys are going to have to show back up, and I think that will start.
By the way, I want to reinforce, you're right, because we already know that a couple of portfolio companies that we work on, they want to bring it to market, and they're bringing it to market early, going into 24.
we're hearing more signs of people taking portfolio companies and saying, all right, we don't want to be, if there's going to be a precipitous run up in May through June, we want to be out January 10th. So we're seeing, when we talk to QE vendors in certain places, we're hearing things like, oh yeah, we're being actually pushed a little harder to get this started on in November. We'll roll it forward really quickly in December. We'll be out of the gates by the 15th or 21st of January. That's an aggressive posture. I think that if you see that behavior, I think it's a very early signal early in the year that these markets are going to start to unlock a little bit.
It's a good point. Don?
Yeah, no, I agree with all that. And I would say, I think 2024 is a year of nuance, the difference in sectors, the different experiences that we're having. I do think the creativity you mentioned around landscaping and HVAC or HVAC, take your pick on the pronunciation. The first time you mentioned that the other day, I was like, what is he talking about? And then I did, in
Have
Texas.
your commissioner go out.
Yeah, exactly. We say HVAC or HVAC, but I think you'll continue to see that. I do think private equity is under pressure to deploy. I think, and frankly, I mentioned earlier the calls I had gotten about being more aggressive. Those firms are backed by large pools of capital that want to put the money to work. So I think we do see more private equity activity. I think we see a lot of nuance among different sectors. And I think within it's interesting because I think Taras mentioned, pricing pressure and people capitulating. I think that's definitely going to happen. But in our world, we've had some, large investors, aggregators, roll-ups come into our sale process and sort of think and posture that things have turned down and been 20, 30% below the median bid, right? And I've had to call and say, look, everything you're reading and hearing, it's not happening where we are. We're here. This is a good quality company. Do you want to rebid? And usually the answer is yes. So I think you're going to have that type of dynamic occurring too across different industries. But again, agree. We'll see the PE groups be more aggressive, which I think is great for all of us.
Yeah, I actually don't have too much to add to all this. I think it was.
We took all the options, Robert.
I think it was very good.
It was pretty robust.
If there's anything, right, it's pretty robust. If there's anything that I just really think really matters right now, it's inflation staying under control, interest rates being under control. If we get a chance for an interest rate cut next year, I think that'll have a big difference and that'll energize everybody. Psychology. And then if Washington doesn't shoot the nation in the foot, which relates a little bit to presidential elections, but it also relates to Washington. There are regulatory issues and there are things like that, but I just, I think we all feel like the less we hear from Washington, that would be better. Let private enterprise do its thing, and so I think that they could probably disrupt things. Of course, there are geopolitical issues, but I'm really focused on, inflation under control. And it seems like this very innovative economy will take care of the rest of it if people can get going. If the economy stays strong, then all the things we're talking about are going to take care of themselves.
One last thing. It's a long tail risk here that's different, right? For the last 40 years, interest rates have gone down. We all have benefited from that because when we buy, we've had a comfortable belief that the multiple will be higher because rates have been going down. If you sit here today and say, what will rates be in the next 5 to 10 years, rates are going to be flat to up, which means it's the first time for most people that have been in private equity where their entry multiple may be flat to down, and so they don't have the same return expectation.
Are you guys underwriting to a lower exit multiple when you run your models right now?
No, man, because
Yeah,
people
they
don't.
can't admit it, yeah.
People can't admit that, right?
Is this being recorded?
But at the end of the day, rates are going to compress, and these prices are going to be different than most everybody who's done private equity for the last 15, 20 years.
Yeah.
I just wanted to add something that was left out. If everybody's not aware, and this is regarding the sellers, if anybody's aware, they need to know that the unified credit's dropping. So, and when it drops, it's dropping in half, back down to 6 million from 13. So the opportunities the windows really starting to close on the planning and also taking chips off the table. So those that are aware, are going to have to do something and measure the multiple and the rollover versus the hold and what's going to happen. And again, geopolitical. If the momentum's going the other way, they may think they may come back if a new regime comes in and there's a changeover. So again, variables. So I'm right on time?
Yep, I think so.
All right.
Any other questions?
Any other questions? Scott?
From an investment banking standpoint, we all want higher multiples. From a selling standpoint, we all want higher multiples. From a buying standpoint, maybe not so much. But as you guys are talking about the fact, it was a great last point where you've been spoiled over the last 40 years, having multiples expand. How do you guys, one of the other levers then is talent, right? How do you, from your guys' perspective, outside of paying people more, I'm curious what you guys have seen to keep that best talent or attract that best talent in these assets, because you're gonna, get a higher purchase price multiple if the talent's there and able to drive value. And what have you seen outside of this sort of thing? We've seen a variety of things. I'm just curious.
I need a clarification of the question a little bit. Just
Yeah, just
So-
around, how do you keep the best talent, right? If
Yeah.
part of the purchase price multiple expansion isn't there, you got less leverage.
You're talking about it at the executive level. So basically when you're giving them option, equity, profits, interest, stuff like that,
Seeing that keeps people motivated to stay there to drive the returns, the investment committee memo.
Yeah. Look, I was going to say is from my seat and what I see, obviously all the things that Corey mentioned, the traditional technical levers, but it's also for us driving M&A in the sense that some of these parallel acquisitions of other opportunities are creating new sort of career pathways and expansions to develop. So there's a lot of focus on creating optionality. And this would probably be more for the mid-level executives rather than the most senior. Those mid-level executives are kind of looking at a new landscape where there's different business lines, different business dynamics, new services, sort of a new type of platform that they can grow into and help lead in different ways. And that, economics being similar, that optionality and that interest is driving, at least in our world, some M&A activity too. And frankly, some of the activity really is about acquiring the talent, even over the assets and the businesses. So, but I would say, broadening the opportunity sets there, even giving equity in some of these separate businesses or new business lines in a different fashion, different weighting to different executives. Those types of things have been a little bit unique, at least for us, outside the standard type things.
Technology sector has had 20, 30 investment firms that are perceived to be better than everyone else, and they can attract talent, retain talent, and attract quality assets better. That's going through the whole market. The need to become a more subject matter expert and industry-focused buyer is just true, because if you can demonstrate you're a friendly buyer, you'll stay with people, you'll reward people, you won't flinch in down markets. Both businesses and executives will rotate to you. There's this whole flight of like 20, 30% of the market is moving to some version of retired. Being able to use those hands to work on your businesses to make them better makes you have a different advantage in attracting what I consider to be this hybrid talent. Those are the things that I see helping our market stabilize. And the only other thing I'd say is that most people got overpaid in the last 3 to 5 years because of rising public markets. And so the good news is that in these boring industries, those operating executives weren't really looking for highest price. They just love what they do. And so making sure you're perceived as a friendly buyer or one that sort of supports management helps you build better teams.
Yeah, just real quickly, we have an annual strategic review process with each of our portfolio companies, and we, starting last year for the first time, specifically asked them to dedicate an entire section of their presentation to talent retainment. I'd say that across the board, it is, if not the number one, the number two issue amongst all of our executive teams. It's very difficult to hire, talent into a lot of our, traditional industrial businesses. From a senior executive standpoint, I mean, we've tried to think of creative ways outside of pure compensation to incent and to attract a lot of these executives into the Blackford Capital, portfolio. We have an annual CEO, CFO conference that we, try to, bring in kind of outside speakers and specifically address, issues that they'd like us to focus on. We try to provide opportunities for them to co-invest in other Blackford Capital portfolio companies to the extent that they would like to do so. And so fundamentally, we try to create kind of a family type environment and a resource for them to extend beyond their executive teams and try to empower them to be better managers. And it's through that, kind of networking approach and through some of the ancillary benefits that we try to provide them to try to create a sense that, that they're part of a special place.
Yeah, we got the hook. So I wanted to thank you guys for showcasing your brilliance. You made it easy, and thank you very much.
Let's give them a hand. Thank you.